Rick Santelli here live on the floor of the CME Group. We have breaking news. July read on import-export prices up 0.2. We're expecting down 0.1, so that's definitely a higher number. Although last month we lost a few. Minus 0.9 now stands at minus 1.1. On the import prices, ex-petroleum unchanged. And if we look at import prices year over year, down 1.8, 0.2 cooler than expectations, and it's also 0.2 cooler than our last peak. Export price month over month up 0.2. Same scenario as import prices, expecting down 0.1, arrived at up 0.2. Although in the rearview mirror, we upgraded last month's export prices from down 0.7 to down 0.6. Finally, the macro view on export prices year over year now stands at down 0.9%, sequentially following an unrevised down 1.6. So arguably, these are firmer import and export prices. But the big story today, minus 65 basis points, a low yield, historic negative yield on a 10-year boon. 30-year bonds intraday have already touched 202. 10 years have already touched 157. 30-year bonds have never settled under 2.099. We'll round it out to 210. So this is going to be a biggie, and considering the yield curve and the fact that it certainly looks like 10s to 2s is in that kind of red zone, and I'm not talking football. Remember, the last time it was in the red zone, meaning inverted, meaning two-year note yields closing higher than 10s, June 5th, 2007. Kayla, back to you.
All right, Rick Santelli, thank you so much. Joining us now for more is Richard Bernstein, CEO of Richard Bernstein Advisors and a CNBC contributor, and senior economics reporter Steve Liesman. Steve, let's start with you and digest that data for us just a little bit.
Boy, there's a lot going on in here. A lot of it is a reversal from a decline in the prior month, and Rick alluded to this. You were down 1.1 in June, which is a downward revision from the prior report, and up 0.2, which is a little bit hotter than expected. So it all kind of washes out. I think the best way to look at this is year over year. 1.8% decline in year over year import prices. Petroleum down 6%, non-petroleum down 1.3%. You're just really seeing reversals here. Motor vehicle prices have been a little bit soft. 0 in June, minus 0.3. You don't know how the tariffs affect all this. I would say in the first order, what we see on these declines here is global economic weakness. It's one of the ways that overseas economies affect our economy, is in part through the import of inflation. As for tariffs, these are pre-tariff prices, so the tariffs go on afterwards. To the extent they're down, it could reflect some margin pressure back on the supplier, but they need to fall in concert with the amount of the tariffs to fully offset it. And it's this kind of data that tells economists how and why they're being paid on this side of the border, not the other.
Richard Bernstein, let's bring you in here. When you look at this unexpected rise in import prices for the month, obviously it's a small enough amount that it wouldn't necessarily be passed on to consumers. But what does that tell you about the economy?
Sure. So, Kayla, we're in a late cycle environment. I know the Fed likes to say that it's a mid-cycle environment. It's really a late cycle environment. The yield curve is telling you that. Late cycle environments are horrible for the Fed. Why are they horrible for the Fed? Because the front end of the economy begins to slow down, but yet you have lingering inflation pressures. And so the Fed is always in a late cycle environment caught between a rock and a hard place. It's not so easy. And I think if you look at some of the recent inflation data, you're starting to see that. Now, it's not out of control. It's not horrible. But what's interesting is the Fed is easing and willing to talk about easing in a late cycle environment. That is highly unusual to see that happen.
Although, what inning are we in this late cycle environment? That's the million-dollar question,
I think
right?
we're in the ninth inning. We're in the ninth inning. I mean, the yield curve is telling you that. It may be the top of the ninth inning. The leadoff batter may be up, and there may not have been a pitch yet, but we're in the ninth inning.
So the Fed's sort of in a no-win situation, Steve.
Yeah, I want to just, before responding to that, tell you what's going on overseas. Rick alluded to this earlier. He talked about, he didn't allude to it, he said it, the German Bund, new all-time low, minus 0.646 if you want to be precise. Also happening in European bonds. And again, the chicken or egg question, are we importing their low yields, or are they reacting to what's happening here? A little hard to tell, but it's all a global downdraft in yields, and that is animating
Agreed.
stocks in a big way.
I agree. But if you look at policy here in the United States, whether it's tariffs or whether it's the Fed easing in a late cycle environment, is a pro-inflation policy. Whether it's monetary or fiscal policy, that is the story.
It's 100% right. Usually the Fed is battling inflation at the end, and now they're not.
Right.
And Joe has a great, question.
But that's the corollary of what I was saying. Was
exactly.
That recessions come when yields get too high, the yield curve inverts, the Fed's got to tighten in it, and they cause a recession. This is totally different. That's why I disagree with you. It's the ninth inning. What is it, a twilight doubleheader?
No,
you don't know. Huh?
A twilight doubleheader.
Did you ever, I used to love
They don't do those anymore. Right? Now
it didn't.
they have two
Crossley Field.
You're so old.
I know.
And,
I know. But with age comes wisdom, which you might be lacking.
But he still has his hair.
Touche.